things we're going to be going through. I have a heck of a lot of information to cover. So welcome one and all. Let me know where you are and where you're calling in from as well. I'm going to, in this webinar, take you through the latest slide. So let's get on with that. We've had the team create quite a lot of information and data. A lot of it you've never seen before. And then, of course, we've updated everything on the markets as well. So you should be able to see and hear me loud and clear. If I look off camera, that's because I'm just keeping an eye on any of the questions that might be coming in as well. So welcome to you all on here. And I look forward to answering every single question that you might ever have about the markets in this webinar. So by way of introduction, one of the things that I'm going to go through is just what it is in a portfolio that you're after. Now, everybody thinks it's just purely return. If we take this, which is one of our clients' model portfolios, everybody focuses on return. They're always saying, well, yeah, I want the return. The main reason most people fail is risk. They fail because they don't understand what risk is. So when there are falls in their portfolio, they panic. Or if for prolonged periods of time it goes sideways, they get bored. And what they don't realize is that a portfolio is a number of stocks, and some of those stocks within it can often drop large amounts, some of them simultaneously. Some stocks drop month after month after month. So 26.9% includes stocks which can drop month after month after month after month after month. That's what 26.9% annualized return involves, unfortunately. You can have individual stocks which drop over 50%. Warren Buffett's company dropped over 50% 3 times in his career, and he became the world's richest man. So it's little things like that that I'm going to explain to you and show to you in this webinar. I'm also going to cover things such as what you should do, or how do you decide with a simple flow chart? What should I do? Should I buy? Should I hold? Should I sell? And a little flow chart to explain those things. And as you just get comfortable behind your seats, grab yourself a glass of water and something stiffer if you wish. And we'll also go through, of course, as ever, the process of we're looking through securities. What doesn't meet our criteria? How do I decide what does? And for those who are on my program, don't have a heart attack. I'll only say this once. This isn't showing the Holy Grail, because none of these stocks meet all our criteria. I will go through some of the ones which do, which I like, some of the ones which do, but I wouldn't buy today. Okay, and so on. And what this does fundamentally is it means if you're looking at your pension, which is just stocks purchased through an IFA and a fund manager, what you're able to do when you take control is avoid all their excessive fees, but have total transparency of what you own, total control of what you own, and an understanding that if you narrow down from 10,000 securities to the 20 to 40 you might want and the rest in cash, you've got a pretty good portfolio where you can see the individual volatilities and decide that you don't want things which are too volatile for you, that you want the ones with a high consistent return, and you want ones with some momentum, with some good, strong cash flow. That comes from Goldman Sachs Wealth Management, which are undervalued companies with good growth. And when you go through 10,000 securities, you're able then to narrow that down without thinking, oh, shall I just spray and pray? What you've been taught has been wrong. What you've been told is if you just buy first of all, you've been told you can trust the expert fund managers. Why wouldn't you believe that's not true? You've been told that they always outperform the markets, or that you should just give them lots and lots of time to do so. But what you haven't been told, other than by Nobel Prize winners like Eugene Fama, is that they underperform consistently because institutionally they pick from a narrow gene pool of securities, either because they've got so much money they can only pick from a few stocks. They institutionally underperform because they're paid only if they're investing your money, and they can't therefore be paid if they're just holding cash, which might be the right thing to do in years like 2022, for instance. So because of their institutional failings, you will necessarily underperform. And you've also been told, don't do SIPs and ISAs. It's only for the big, clever, rich people. You're too stupid to do SIPs and ISAs and select your own stocks, even if those stocks might be household names you're familiar with, whether it's a Rolls-Royce or a Costco or Walmart or Intel or IBM or whatever else it might be. Because those people in the fund management industry love to charge you fees to underperform. And as I said, institutionally, they're set up to underperform. So we will go through that in here as well as what's going on in the markets. I will also take you through some of my most important findings as well, and take you through just what we're looking at the moment, both in terms of stocks and some of the most important postings that I've made at the moment, and what we're seeing from Goldman Sachs, JP Morgan Asset Management, and so on, just simplified, even for the non-expert, so you know where you are. Okay, so I'll find all of this. We'll cover the budget. If you're in the UK watching this, and do let me know whereabouts you are who are watching all this. We've got Warrington, and we've got all sorts of places, so that's good. We normally have people from the US as well on this, and some of my clients. Andrew, I can see you're over there. Andrew, as I said, don't worry, that's not the holy grail. Sometimes first time clients come on here and they say, oh my God, you've just shown the approved filtered list. I haven't actually. I've shown the ones which don't fit our criteria, and that's very important for people to understand. And then I'll discuss what I might like at the moment, a few things. And the broader market. So let's get on with all of that. And I want to start off with some of the political stuff and the macroeconomics. Now, at the moment, there is a 50-50 chance that the US might reduce interest rates in December. Why is this important? Well, it's actually an important factor to determine whether or not stock prices might fall. However, it is not a fundamental structural change in the economy. If they don't cut it in December, chances are they'll do it later. In other words, the short-term volatility and uncertainty and noise you're seeing on the news sites, which I'll show you in a second, is not some reason for you to panic. In fact, it's good news if they don't cut it in December, because it keeps the market anticipating and waiting for later cuts. If they stop the cutting cycle, as happened in 2018, or the fear of it happened in 2018 and 2022, then what ends up happening is the market falls, okay? We're not at that stage. And one of the most important predictors of stock market tumbles, prolonged tumbles, not the V-shaped ones, but the U long-term shaped ones. So the V-shape happened with tariffs, V-shaped recovery, quick recovery. The U-shaped ones was and has been interest rates, okay, in the US. And people forget, in 2022, the S&P fell 25% at one stage, or 24.9% at one stage. A quarter of people's pensions would be gone. And if you were a Scottish mortgage investment company, 50% of your pension went. 50% went from the expert fund managers, and God knows how many St. James's Place funds needed to be rebranded, remarketed, and reassessed equally. Now, why did that happen in 2022? People have even forgotten it happened. But interest rates, okay? So what I'm saying to you at the moment is we're not at the bottom of that interest rate cutting cycle. Why would interest rates make such a big difference? Well, companies, particularly technology companies, have lots of borrowing. Governments have lots of borrowing. They all have to pay interest on it. You have lots of borrowing, maybe mortgages. You have to pay interest on it. Interest rates are lower. Companies have more money. Governments have more money. Consumers have more money. There's only three parts to an economy: government, corporate, consumer. And if you're in one of those three, you're impacted, which everybody is, you're impacted by interest rates. So that's the most critical fact. You might say, well, wait a minute, what about fiscal policy, i.e. tax? Tariffs are tax. They led to a V-shaped recovery because the independent banks move interest rates in our favor very quickly. They react to keeping growth going, even if governments don't through taxation. Governments impact taxation. Central banks impact interest rates. Okay. So what's good news for us? Well, whether they cut them in December or not, it's positive. You may well panic before that, thinking, oh my God, my portfolio's down, because you're unaware that individual stocks can drop 10, 20%. If they're good quality companies, you don't need to worry anyway, because you should hold on to them. So let's get on to, and I'm going to give you a little table on what you should do and how you remove that. I've written an article about it. Actually, I'll show you that now. Which I shared with my clients. I don't mind sharing this publicly because it's not mentioning specific stocks. My clients expect me to keep specific stocks separate, but they don't expect me to stop writing, whether it's my books or otherwise. So this is a rather good table. And what we've done is here, I've taken Warren Buffett, Jim Simons, who's the greatest hedge fund manager in history, Warren Buffett, and Eugene Fama, who won the Nobel Prize in economics. So I've taken three individuals, and on that decision of whether, when you should buy, when markets fall, when should you buy, when should you hold, when should you sell, I put that there. And you can take a picture of this if you wish. Now, what you need to know from all of that is who these people are. Well, we all know who Warren Buffett is, one time the world's richest man, okay? Jim Simons, hedge fund manager, the most profitable hedge fund manager in history, more profitable than Warren Buffett. Okay, he just happened to start later than Buffett. Otherwise, his rate of growth was significantly more and became a multi-billionaire as a result. And Eugene Fama won the Nobel Prize in economics and also is in the asset management industry as well, just ridiculously successful. So you can read all of this in your own time, and I'll incorporate some of this in here. Because the paradox of investing is when markets fall, wait a minute, shouldn't you sell so you can buy back cheaper? Oh, no, you should just hold through it because it'll always recover. Or wait a minute, shouldn't you buy more because it's getting cheaper? Wait a minute, all those three things are conflicting. So how do you know which one of those to do and when without hindsight? All right, so what we did is, as I do with everything, I back it up with data and I back it up with academic credentials or with asset management. So Warren Buffett, asset management, Eugene Fama, Nobel Prize winner academic, and asset management, and Jim Simons, asset management. So I'll use those, and they're the best and the greatest in the world. I mean, why would I want to pick anybody better than the very best in the world? Because after all of this knowledge I'm sharing with you is what I use on my son's portfolio. And I want my son to have the best in the world. I assume you all do. I mean, somebody once asked me, why do you share all of this? And I said, well, purely selfish reasons. The selfish reasons are I'm using it for my son. And the fact that you also know it doesn't make my son any poorer. Probably makes him better off, actually. Karma and all of that. Anyway, so I wanted to share that one with you. You've got the image there. Let's move on to some more of the political before we get into the individual stocks. I know everybody comes to these things because they say, give me a stock name, give me a stock name, give me a stock name. I want you to be less newsletter driven because that'll only end up bad for you. But we will talk about stocks, but I want you to be more professionalized by looking at it in a portfolio sense and not being so panicked and not being so bored. I'm going to give you all a free copy of this book, which has been reviewed very nicely by the Financial Times, by Bloomberg, and by $2 billion hedge fund manager. So I'll make sure you get all, if you haven't already got a copy of that. Let me know if any of you haven't got a copy of Investing Unplugged. I mean, I'll give you a digital copy because mailing things out is inefficient and costly. Let me know in the chat box if you haven't got a copy of that. Okay. So global equities sell off sharply. That happened in the last 24 hours. Tech and AI. What? Seriously? Was it because suddenly people have discovered they're overvalued? No. Are they overvalued? No, they're profitable. It's just some profit taking. It's momentum. Okay. What moves markets? Well, valuation is the bedrock of any pension, any good portfolio. And valuation is earnings, profits, okay? And hopefully a strong balance sheet. Companies only have three things: P&L account, cash flow, and balance sheet. Balance sheet is your assets, hopefully big fat assets. That's the safest thing to look at. Beyond that, profits, because profits might come and go. Assets stay longer, don't they? They sit in your, profits might come and go this year, next quarter, but your assets presumably are sitting there. If you're profitable and you got cash flow, then they're definitely sitting there. It's suddenly you've lost the assets if you're both cash flow positive and profitable. It's hard to do, in other words. Now, the point I'm making is that you got valuation first, then you got growth, revenue growth. That's a little bit on top, and that could get a bit frothy. Some companies that's slightly shorter term. Growth can come and go. You get a good advert campaign, you're doing well, you're flavor of the month, and then finally you got momentum. Momentum is the first to go. It's in and out. It is the seductress, and momentum last night went for a day. Well, who cares? That's noise. So calm down. Turning to the UK, Chancellor Rachel Reeves has abandoned her plans to raise income tax. So fiscal policy is all she can control. Now, university economics exam question I was asked was, is fiscal and monetary policy really just the same thing? It's just supply of money. Put that to one side. She can only control taxes. Who cares? Because the Bank of England will step in and reduce interest rates if she's too tight on taxes. Fine. Perfect. We're okay. So that whole budget uncertainty, relax. Okay, just relax. Sterling sharply lower. Fantastic. It means UK companies who book their profits in dollars, when they convert them into sterling on their books, it looks like they're more profitable than they actually are. That's why British companies in the FTSE 100 is doing better. It's technical. Sterling is lower. That's why. Okay, so you can ignore that. It's not that suddenly they become more profitable. One or two have. Certainly not because GDP is growing at 4% per annum, because it's not. Okay, it's not because unemployment is at 1 million. It's not. It's around 5 million people out of work. Okay, so why the hell is the stock market at all-time highs? Technical reasons to do with sterling and the fact that most of these companies earn their money in US dollars. All right, so any budget uncertainty, it's noise. Stop panicking. Most of my time I have to spend telling people stop panicking. Gold up 4.6%. Now, the crazy thing about this is the damn thing doesn't pay income. Okay, it doesn't have profits as such. It is just simply a metal which is not going to put food on the table unless you literally sell the capital value of the asset. But it keeps going up. So it's a momentum play. And if you're happy with it, go for it. I'm not a gold expert. My wife bought some gold coins in December, as you will know. I've mentioned it many times, including the time when she bought it. She's very happy. She certainly doesn't think she's an expert. I said, do you want to buy some more? She said, no. The person who we listened to about this is a man who came to this country about 30 odd years ago, worked at Heathrow Airport, friend of the family. He's always been looking at gold because he's Indian. And every day he's looking at gold in the markets. And I asked him, I said, Uncle, what the hell's going on? And I asked him about 2 months ago, this keep going higher. And he gave me a pretty good macroeconomic and political reason why he thinks so. And I went, okay, well, I don't know. You're a former baggage handler at BA, but I don't care what your background is. You're certainly smarter than anybody I read about on the internet or at the investment banks. I'm going to go with you. And you've got skin in the game because you've got a bloody 1,000 of these flipping coins over the last 30 years. Anyway, I'm not a gold expert. So all I can tell you is if you want 5% of your portfolio in gold, go for it. If you want to trade it, I'm not your man. If you want to go short gold, probably more to the downside than there is to the upside. Oil, as long as it's below $80 and it's currently around 60-ish, you're fine. Stock market, don't need to worry. Cryptos have fallen below $100,000 for Bitcoin. Noise, if you want to buy it, I wouldn't buy it yet. I'd probably wait till it drops. If it drops to 70, I'm not saying it will, $70,000. I'm not saying it will. And you hold it like modern art. In 10 years, either it'll be worth something or it'll be worth nothing. At least you won't be able to say, Alpesh, you told me to get crypto. No, I didn't. I said it'll either be worth something or be worth nothing. God knows. And if ever you find somebody who's got a very strong opinion on either a security or on crypto, it's because they're gamblers. They must be. Otherwise, they wouldn't be so emotionally attached and married to their positions. If they start getting angry, they've either got some kind of anger management issue or they've put too much money into it, which is what gamblers do. So stay clear. Please remember, nothing I'm going to say to you is individual stock advice. Please, because I don't know you individually, please do not. John, thank you. Okay, anyone else as well? Great. I'll tell you where you're going to get the copy of the book now. John, everyone else who's not got a copy, there's something should pop up on your screen right now, and you should be able to digitally download it. Let me know if that's come up and you can see it, okay, because I've put that up. And you should hopefully have that up there. I'm also going to put a poll up and see how many of you think the FTSE 100 is going to be higher by the end of the year. This is usually a pretty good inverse indicator of what's actually going to happen. So it really helps me. Ted from Washington. I used to work in Washington. I lived at 201 I Street Southwest, and I thought I thought cars were backfiring every night until I realized it was gunshots. Scary time, but ignorance is bliss. I didn't know there were gunshots, so I just go out all the time. That's our offices, 84 Bridge Street. I wish I could say I own the whole building. Come on. We have very nice landlords, so let's just put it that way, and very expensive ones. But that's where we're based. What am I going to talk about? This is what we're after. Okay, this is what we're after. Now, when you do it like that over 15 years, it looks really simple and easy, doesn't it? You want to try and grow things at the maximum possible rate and return. We've got Paul S., now that annualization, past performance is no guarantee of the future because tomorrow the world could end, for a start. If it did half as good, and that's why we need a big buffer. If we did, instead of 26.9%, you did 15%, so you did half as well, that still doubles your money in 5 years. In the 1980s, when I grew up were we still in Armley? I was born in Armley in Leeds. If you know Armley, you know that's the rough end of town. Property would double every 5 years. Okay, if there was a recession. If there wasn't, and in the 70s, there were a lot of recessions. And if there wasn't, like in the 80s, we had slightly fewer, it would double in 3 years. Portfolios, 15% per annum is doubling in 5 years. Okay, there's no guarantee of that. You have to have good quality companies. They usually tend to be American companies because they've got more choice and they tend to grow. Just watch the news. But the point is, and you can't do that with property anymore because governments tend towards removing things which will make people wealthier. It's just the way of all governments. Too many people making money in property, right, let's F it up, make sure they can't do it. Landlords making money, stop it, shut it down. They find something making too much money, shut it down, usually through taxation or regulation. Okay, that is the job of the elite classes that are the politicians, time and again. Rarely have there been periods where governments have said, right, we actually want people to make lots of money. And if it is, it's usually a small group that end up making it. But the point being, stock market, they haven't shut it down yet. They're trying through SIPs and ISAs to reduce the amounts because they know people are making money in the stock market. Okay, they know in SIPs and ISAs people are making money. They're not doing it in property. They're doing it, especially if you're watching this from America, they're definitely doing it. So it's getting shut down slightly. The raid on pensions is what all banana republics do in Eastern Europe and Latin America. It's coming our way. But for now, our job is to invest and try and make as much as we can. This is the goal, okay? And even if it becomes 15%, it's still in 5 years. Now, it doesn't go like that. It doesn't work as smoothly as that because guess what? People end up needing money during the course of, year one. That might happen. Then they think, oh, crap, we need to go on a holiday or the markets drop. And then this, that. This is what happens in reality, okay? And might be even worse, and before you know it, hopefully you get to there, but you might end up there. Okay, that's the general goal, that you can turn what might be 10 into that. That's just math. That's compounding, as you know, right? So the only numbers we're playing for are we want to make sure we're not with an IFA giving us a shitty 5%. Okay, I've taken nominal terms here, not inflation adjusted. So inflation's out of my hands anyway. We're playing for 10 to 20. Anything above 20 is what we want to aim for. But if the market's as good as it's been in 2023, 2024, 2020, 2019, we'll get above 20 because that's the market delivering, not me. Okay, but let's say it's not. And we want to try and avoid anything below 10% because it's pretty shitty. Okay, 5% is what your IFA and wealth manager will talk to you about because they can then bleed you drier for longer. 20% is going to be a tailwind. You're going to need an economic tailwind. You can't do that like in 2022 when the markets fell. I'll show you. I can't do that. We got zero. We got nothing. We had all cash because it just didn't look like there's anything. There was something in 2022. There was Eli Lilly, but I didn't have the balls to put my money in Eli Lilly. The only thing that went up pretty much when everything else is falling. Would you? I don't think so. You'd say, well, I'm not going out in the rain thinking I'm the only one going to stay dry. So we're going to look at how we do that. Now, what's happening at the moment right now, just to keep up with some of the news, is pension lump sum withdrawals have soared. Can you please be cautious about this? The reason I say that is when you're taking money out of a pension, I've written an article about this on my blog in detail. What you're doing is you're removing it from a tax-free wrapper because you think suddenly there's going to be a massive tax hike and you're not going to have any time to consider it. So it's campaignforamillion.com /blog. And there's a lot of stuff here about ISA changes that might happen and so on. And it's relevant if you're American or British. But certainly in terms of the amount of money coming out, there's an article in here somewhere. You can have a look at. I've written to me. That's since just October 26th. That's just in the last 3 weeks. I've done quite a few. So it's in there. If you go through it, there's one specifically about taking cash lump sums out, and just be careful because you're moving it out of that tax-free wrapper. Okay. It's almost as if you think they're going to confiscate your money. You better have a run on the bank. So the only thing I'd say to you, and this data is from the FCA as well. All that money, where's it going to go? Well, the good news is most people are probably not going to invest it in the stock market because they've just taken it out of the stock market. They're probably going to start consuming and spending, and that might be good for the economy in any event. So there might be actually good news that they've got all this panic to spend this money. They've basically just caused a bit of an inflationary boom in the market. I'm just going to make sure I can see all the questions because sometimes I say things. Good. You can see it, right? So for those who don't know who I am, there you go. The chubby bloke often on BBC News. And those are just some of the books I've written, usually published by the Financial Times, including esoteric ones on stock futures. That was with the London International Financial Futures Exchange. Okay, fine. Don't buy the books. You don't need to. I'm going to teach you everything in this webinar. I'm also on LinkedIn, so please do follow me on LinkedIn. Me with my team outside number 10. I do all of this. The reason I'm showing all those images is to say I'm going to put some of that knowledge into this webinar, okay, from all the various sources I get information. The idea is to create a mosaic and then give you that input. Now, what you want to know is what to buy. I want to give you a warning and be a bit careful. I've written about this again in the book, which I've given you a free copy of to download. It's also available at alpeshpatel.com/links/links, okay, for free. And it's one of the 18. And there's academic research to prove what I'm about to tell you. Anything I tell you is not based on experience. It's based on the literature and so on. Just be careful when it's a journalist or a newsletter. Okay, they have a massive conflict of interest with you, and the academic research shows they're rubbish. They're very good at marketing. They'll cherry pick some of their winners and say, "Oh, we're geniuses. Look, this stock has gone up." And one of the latest things I've seen, which is really dishonest of them, is they'll say, "Oh, we've got this stock and it exceeded, it beat analysts' expectations on earnings and on." So earnings is profits, that's called the bottom line, and revenue, sales is revenue, and that's called the top line, okay? And the top and bottom lines, aren't we clever? Well, no, 90% of companies do that, okay? So they're really being dishonest at the moment because they need those subscription numbers and they need eyeballs, so they get more breathless. And as Warren Buffett said with newsletters and journalists, they get breathless. Okay, breathless headlines is what you'll see. Be careful with brokers. They're just as bad as journalists, and they have a conflict of interest. They need you to buy and sell and trade. The fund managers are terrible. They're one of the worst. And Eugene Fama got the Nobel Prize in economics for this because institutionally, it's why I'd never have a retail fund. Institutionally, they are built to market because to get as big as possible. And when they're so big, they can only pick from very few companies in very few geographies. So it's as if you're saying, well, I think I want to pick the England football team to win the World Cup, but they can only come from Armley and Leeds. Well, great. I'll be the one. I'll be replacing Jude Bellingham then. All right. What do you think the chances are we're going to win the World Cup with me up front, the number 10 at England? Yeah, I know. Some of you are going to say quite high. Banks not too bad. They can move the markets, but that's hard for people to find. So I'm going to share some of the information from Goldman's and the like, and it can be quite useful. Word of mouth, simple, obviously very dangerous. Man in pub. Gurus, Buffett, again, hard to find. They often have other, and I'll show you, let me just share with you what's in Buffett's portfolio right now. So you get, so you don't think, oh, he's just teasing us, but he's not actually telling us. Let me just share my screen on that. Okay, so here we go. Right now, that in and of itself, actually, let me just check that's the latest one. I'll give you the latest one. Okay. In and of itself is not necessarily, here we go, is not necessarily going to tell you to buy that now. Because if he's bought it in 1975 and he's earning a ton of dividends, how the hell does that help you? It obviously doesn't, okay? It obviously doesn't, and that's the danger. I'm just going to pull up the chart. Actually, while I find that, let me show you this one. Please bear this one in mind, and you can take a picture of it, okay? You can take a picture of that when you're thinking, when should I buy, sell? When you don't have 2020 foresight or a crystal ball, what you should be doing is this bit, okay? You should be doing this bit. All right, it's as simple as that. You decide your risk appetite and you do it accordingly. That portfolio, it's not confidential, so you don't have to be on my program to know this. I just find it for you. But I wouldn't be buying these willy-nilly just because he's held them. He's had Kraft Heinz, which is an absolute bloody disaster for him. And he's got limitations. The genius of the man is that he can make a positive return when he's got so many billions. But there are reasons why he can do that. Bill Gates, you can see his Goldman Sachs' holdings. And look, this is in the public domain, so I can tell you anyway. Yes, I have NVIDIA, Microsoft. I have 3 times leverage on the S&P 500 and 2 times leverage exchange rate on the S&P 500. I have Apple, I have Meta, I have Amazon, I have Broadcom. I don't have Tesla, not because I don't think it'll go up, because I just don't want the volatility. I have Alphabet. And that's fine. I've said that to people on YouTube for years, what I own. Well, some of the things I own, I don't just own that. But what actually gives most of my returns this year hasn't been those, actually, funnily enough, oddly enough, and I'll come to that a little bit later on. So just be careful about that. This isn't up to date, okay? What I'm showing you is what we look at. As you know, it's this. That's the Dow. The Dow only has 30 stocks in it. I'm not saying you pick from the Dow or the S&P. You pick from 10,000, you narrow it down. But what's critical is you would think these 30 companies, at least 1 or 2 of them must be the very best. Not one of these at the time I took a picture of this met our criteria. And this is going back a couple of years now. And it was to make the point to people that even some of the biggest and the best didn't. Apple, by the way, was in our portfolio, as was Microsoft, Meta, Amazon, because they're what's part of my quality companies. But otherwise, they've all got to go through this requirement, and they didn't meet it. So you can imagine the high standards I want, because it's my son's future returns that we're worried about. And it's been rather good by having this approach and holding for a longer period of time and not trying to chase the next newsletter headline and trade, but hold into quality companies, which if they fall, we could even buy more of. I've also written this. I'm going to share some of the insights in this webinar about this. This was one of my first books. I think it was my second book, but it technically might be my first one, depending on when they got published. 1997, Lessons in Trading Strategy from the World's Leading Traders. So Bill Lipschitz was global head of foreign exchange trading at Salomon Brothers. His chairman was Warren Buffett earlier in the 90s. And now Bill is hedge fund manager of the year in a few years ago. Anyway, so I'm going to share some of the insights into this on here. And I've been writing about this. I mean, that's 2005. That's an article from 2004 in the Financial Times. So long in the tooth. Where are we on the S&P 500, which is one of the important things you want to know right now. This is where we are. Now, what I have found over the years, better than trying to interpret narratives and newspaper headlines, and I'm going to do the newspaper headlines. I'm going to come to the S&P in a second, but I just want to show you the newspaper headlines. Rather than trying to interpret this, and don't forget, I had my own show on Bloomberg TV. I massively respect Bloomberg. They've got the best financial journalists in the world and the highest standards in the world of journalism, financial journalism. However, rather than trying to interpret this in the direction of the S&P, I've certainly found looking at where people are actually putting their money is better. And I'll tell you why. Journalists may call it wrong. They're, after all, journalists. I've worked inside Bloomberg. Those journalists are not investors. Okay? One. Secondly, where people are putting their money, that gives you a better idea of truth than journalistic narrative and articles. And so what measures where they're putting their money? Well, prices, but also, more importantly, the change in short and medium-term average prices, the direction, the momentum of change. I want you to think of it like this. The way that you measure momentum is this. If I throw a ball up in the air, you would say, oh, that ball's still going up. Okay. But if I said to you, wait a minute, I can see the rate of change of the ball, the rate of change of the speed of the ball, and it's decelerating as it goes up, even though it's going up, it's slowing down. And as it slows down, you get a better idea of where it's likely to peak and then drop. Now, that's physics. If the stock market is physics, you could use physics and work that out. And for those of you who know your calculus and mathematics, you'll know I've just talked about calculus and deceleration, rates of deceleration and local maxima and minima. And what was it? D2y over dx squared, calculus of working out rate of change. Put that all to one side, because physics and maths isn't the stock market. All that's measuring, in a way, is that what it's trying to do by looking at average prices is, are they slowing down? In other words, is it rising but just starting to slow? So we get an idea, not a guarantee, that we might be about to turn before we go back up, before we do that again. And you will notice that the markets do frequently, but not predictably, sadly, not predictably, not with guarantees, tend to do that. And all we're trying to do is simplify that into this. And all I can tell you at the moment, don't overanalyze this, is to put it into simpler language, is that we are, of course, looking very similar to this period here and this period here. Now, at the moment, do I buy more? Well, I'd have to do it cautiously, because look, last time when it was like this, it fell. Last time it was like this, it fell a lot. Would I hold if I already own it? Yeah, because I don't have a reason to sell. Would I sell now? No, because I don't actually have a reason yet to sell. I don't want to sell prematurely, okay? I don't want to sell prematurely. So where does that take us? Well, where that actually takes us, therefore, I'm just seeing if I created a clever little, no, I haven't. Where that takes us is I'm willing to cautiously buy more S&P. I already own enough, so I'm not really going to buy any. I'd continue holding it. Now, I want you to know something else. There are three types of market falls. Okay, I'm going to call it after the bears: baby bear, mama bear, and daddy bear. And what I'm about to tell you could make you very rich. Can't guarantee it, but it could. I'm not even allowed to say it. There's so many regulations. Now, they're not guaranteed. Nothing's guaranteed. Now, when the prices fall, but the average prices are not slowing down here, then you can usually ignore it, and we call that a baby bear. When the prices fall and this is falling, I'd call it a mama bear. Okay, and that means the falls could be deep, and they might continue, and mummies could become daddies, as they did here. Okay, and I call that a daddy bear when it falls and the average is falling below its own. The blue line is the moving average off the average prices, so it's an average of an average to smooth it out even more. Anyway, pattern recognition, that's all you should think of. Now, there's two types of recovery. So there's three types of bears, and there's two types of recoveries. There's the U-shaped recovery, and there's the V-shaped recovery. Okay, now technically you might say, well, surely there's others, but there's two types. Now, the V-shape or the U, nobody ever knows which one it's going to be. I know there's a lot of people who are more than happy to gamble and guess which one it's going to be and goof off and say, oh, it's going to be a short, sharp one, or it's going to be this. There's people who will tell you when things are going to fall and how deep, when and how. Not me. I don't know when. I don't know how deep. I know strategies of what to do based on what happens, just like in a war. I don't know when I'm going to be attacked and how badly, but I know if they do that, I'll do this, or if they do that, I'll do this. Just like in football, the manager doesn't know necessarily what the other side's going to do, but they know if they do this, we'll do this. If they do that, we'll do this. That's all you can do because you don't have a bloody crystal ball. And if you gamble, the worst managers are the ones who gamble that they're going to do this, and the other side doesn't. They're wrong-footed. They bloody lose 10-0. Okay. So my point to you is this: what happens depending on those two? Because we've really simplified it now. So one of two things can happen. First of all, you only need to think about exiting if it's a mama bear. If it's a baby bear, stay relaxed. Simple rule. Rules, protocols, policies, procedures, they make your life stress-free. So if it's a mama bear, you can exit some if you wish. If it's a daddy bear, you could exit all. Now, what if you decide not to do that? Because there are only three choices you have: buy, hold, or sell, right? So we simplified again: buy, hold, or sell, mama bear, daddy bear, baby bear. Okay. What if you held on? Well, if you held on, the danger is that you have a long U-shaped recovery. You say, well, I still made it, and you made 0% over 2 years. Well, what happens if you sold? Well, the pros are, if you sold on a mama bear and a daddy bear, you could buy back cheaper and you get a massive 300% return when everyone else is still getting 0%. Okay, pros and cons. You can't see the future. So you might do 50-50, sell a bit, not. What about V-shaped recovery? Because you don't know what recovery it is, remember. What if it's a V-shaped recovery? What's your best strategy? Those who understand game theory will know where I'm coming from when I'm talking about all this. What if it's a V-shaped recovery? You don't know whether it is. I didn't know earlier in the year it was going to be V-shaped recovery. I didn't know that was going to be a U-shaped fall. Okay. What I did know is if it's a daddy bear, I'll get out. I didn't know it was going to be a daddy bear. I didn't know how deep it was going to be or long. All I knew is if it's a daddy bear, get out. That was all. That was all. A bit like if it's raining, take an umbrella. How long is it going to rain for, Alpesh? How tumultuous is the rain? I don't bloody know. We do this every day. Why is it with the stock market we suddenly want more certainty than we're even willing to accept when we go outside? Okay? If it's a dark little alley and it's 2 a.m., maybe I won't walk down there. Oh, how certain? Well, when will I get mugged and how bad will the mugging be? I don't know. Let me just not walk down there. Similarly with this. Are you going to get mugged by the market or not? Simple procedural rules, all you need to remember. So looking at this, okay, what you would say simply is, well, it's not a mummy bear, so I don't need to worry. Move on. Wait another week, 2 weeks, 3 weeks, if you so wish. What if you held through? I told you what the danger is. What if you sold? Well, if you sold, it might be a V-shaped recovery, and it's the insurance premium you pay for buying back more expensive later. So pros and cons. The pro is if you sold on a daddy bear, it might fall more and you can buy back cheaper. The con is you might have to buy back more expensive. Obviously, I'm only stating the bloody obvious mathematical outcomes. Right, very simple. So now you've got an answer to absolutely everything. Type of market, when to buy, when to sell. Well, when to buy we'll come back to, but when to sell. We've only discussed selling. All right. Now, I only do that with indices, exchange traded funds, and what I call my quality 5+ stocks. You can't do that with every stock. I'm talking about the broader market. And if the broader market looks like this and it's a daddy bear, then I wouldn't want to be buying anything, any stocks, anywhere at all. Okay. And that's the other way I save money and not lose. One, by getting out there, I buy back cheaper there and I'm making money when it's rising. Fund managers can't do that. They're not allowed to hold cash. Secondly, they will keep buying, trying to find falling knives. I won't. I'll just sit back and say, I'll just wait for the storm to finish. Calm, cool, collected, and that works every single time. You only have to look at the price charts to know that works. But what do private clients want? Oh, no, Alpesh, tell me the secret company that you keep on the top shelf and behind the cupboards that you're not giving anybody else, in the closed room with the lock where you go smoke your cigars. No, there isn't a secret room. There is a strategy to it. Rahul, I'll answer your question shortly. Now, what have we got coming up? Okay, we have got coming up into it. We have got coming up, most importantly, you can see it there, NVIDIA. All right, that's going to be the market determinant of what's coming up. How's the past week been? Well, don't be put on. I mean, I don't want that volatility, so I don't have the stock. Okay, I have no doubts Tesla will double in 5 years, if not more, but I don't want it. Most people don't. Until they own it, they don't realize the panic. And if you're not sure and you think, I've got FOMO, I really want to own something, start with a small amount. See how you feel when it drops 10%. And the weird thing about people is, it's like house prices. If somebody checked your house price every single day, and Warren Buffett gave this as an example, and said to you, it's gone up, gone down, would you suddenly, if it said, oh, it's gone down 10% in a week, would you say to your wife or husband, let's sell the house, sweetheart, it's gone down? Of course not. So why are you looking at the prices every day? It's not good for your mental health. When we did my Bloomberg TV show, it was our job to talk the markets and what's happening today. It's not bloody healthy for you, but how do I say to the viewers, please don't watch me? It's like that, why don't you, in the 1980s children program, why don't you just turn off the TV set and go do something more interesting instead? You really should. Except you should watch this webinar because it's educational. Okay. Oracle in a week. Now, the problem with something like Tesla and Oracle is they're good companies. They're just too volatile. I don't need the volatility, so I don't want it. Eli Lilly had a good week, so somebody's going to talk to you about sector rotation. Are you suddenly going to find a thesis that buy a company which has gone up 9% in the past week? Well, have you tested that? No. Take the scientific approach. Have you tested it? No. Well, then shut up. Stop throwing your money at it. Like I say, the wonderful thing about private investors is that every high street should have a casino and a Ladbrokes, because private investors are gamblers by their very nature. On small pieces of information with no evidence whatsoever and no testing, no thesis, they will just throw their money away, which they've spent energy and effort earning. Absolute gamblers, totally reckless. That's why spread betting companies do so well. It's why Ladbrokes does so well. It's why casinos do so well. Retail clients, absolutely insane in my experience with just how gambly they are. Honestly, it is shocking and worrying. Now, there will come a time when I go back into LAM research. I'm not in it at the moment. I'm not going to do it at the moment, okay? Yes, I happen to own JP Morgan. Have I panicked because it's dropped 1% in a week? Obviously not. I happen to own some of that. That's my business. My son's business. The fact that we might have Visa and MasterCard's his business, and you might think it's too boring. The fact that Goldman Sachs has gone up 2%, does that mean I suddenly get over it? No, 1 week is noise when you're investing. How about the past year? Well, you're not going to invest just off the back of that. What moves stock prices? Value, growth, income. We know what moves stock prices because guess what? People have researched it. Profits, dividend yields. But each of these factors, the weight is different. So the fact that over the past year, Broadcom has gone up 90% is not reason alone to buy Broadcom, obviously, or Walmart, or Amazon's only gone up 14%. Apple only 21%. I told you the ones that I've got, they're not the ones which have moved the market the most. I'll show you what has in a second moved my portfolio the most in a second in a very calculated risk way. But I already know that in hindsight. I didn't know, if you said to me at the start of the year, I'm going to give you this table blank, i.e. just with company names, not the amounts, can you fill in the percentages they'll move? Of course I can't. And that's with all my years of expertise. Neither can Warren Buffett or Jim Simons, which is why we don't just have one stock. Okay? In fact, I tell you what, if at the start of the year you said ServiceNow, which I think is a rather good company, was going to be down, I've only noticed it now. I've had it in previous, I don't have it at the moment, would be down 18%. I'd be rather surprised. If you said Adobe is going to be down 33, I'd raise an eyebrow and say, well, it's feasible, but I'm a bit surprised. I think they're not firing. They're a bit like Disney. The great brand name should be doing a hell of a lot better. If you said Cisco is going up 31%, I would have been surprised. And I would have said, well, for years, they've not been the ones that have done well. For instance, if you said Micron's going to go up 118, I would have said, yeah, it's feasible. AMD, yeah, it's feasible. NVIDIA's only going to go up 28% and less than your Goldman Sachs holdings. I'd say you were insane. And yet it has. That's why I don't just have NVIDIA. So basically, I called all of this wrong at the start of the year, in the sense that I didn't know the size of the moves or even the direction in some cases, and yet made ample money because I had a bit in everything. Not everything here, but a lot of these things. So what do I have? How's it done? How's it done with my clients? Well, the clients narrow that down and then we create a portfolio for them where we will look. And this is the most important thing we do for clients is this part. Is we make sure they understand the drawdown. Because guess what? If I give a client the goose that lays the golden egg, i.e. something which makes money, how can I ensure that they're not going to mess it up and kill the goose? Through panic and boredom, by showing them what's in the portfolios. And this is one, they pick their own. I didn't make this portfolio, by the way. A client took our approved filtered list and made one for himself. And then we go through it and say, oh, yeah, that suits your risk appetite. because there's infinite permutations from the approved filtered lists. And so they make it. We show them how to make the cake. We look at the cake and we go, well, that's a bloody good cake. I'm going to share that with everyone else in the class. That's how we work. Okay. And it's very easy, very straightforward. But we then we cut the cake open, look at all the individual stocks. And I'll tell you with this one, what was shocking is there were some stocks which were down 5 consecutive months. There were some months where 3/4 of the stocks in the portfolio dropped and some of them double digits. And that still doubles your money in 3.5 years. No guarantee the future will hold what the past has done. Okay, so it's extraordinary. Exchange traded funds, okay, nothing much to tell you on this. That's been the past month. Obviously, if you had crypto, you got screwed. But if you had crypto and you got panicked with a 16% drop in 1 month, then you're obviously delusional or you just love gambling. Because you know that can happen. So it shouldn't have come as a surprise. Yet, time and again, clients panic or they get bored because things haven't moved quick enough. Retail clients are very easy to make money out of if you're a newsletter writer or a stockbroker or an IFA or fund manager. All you have to do is dangle bright little things which make them either panic or get excited. But if you tell them, look, my job is to make sure you don't get panicked and you get bored, then nobody wants to hear from you. But that's actually the way it's done. It's what Warren Buffett teaches, you know. Markets over the past year, rather unusually, the UK's been the one leading. That's very unusual. Now, what will happen is a load of fund managers will advertise the fact that their UK funds did really well. And so everybody's going to pile into it because there's academic research to show people buy last year's winning funds, which is, and then the research shows, and that gives them no edge at all compared to just picking a random fund. But you're going to do it because your brain is wired that way. Daniel Kahneman, Richard Thaler, both independently of each other, got the Nobel Prize in economics for showing that this is how people behave and they're irrational. If they were rational, there'd be more rich people in the world as well. Okay. I'm going to answer all your questions towards the end, Piet, good, and just to keep the flow going. So the UK should revert back to mean. I mean, you tell me, for those of you in Britain, why is it up 30%? Is it because our GDP is 4% per annum? Well, it's not. It's closer to 0.1%, I think. Is it because employment is at record lows? No, it's at 5 million people who can't be asked working. In some cases, can't be asked working. Some cases, genuine reasons. But there's a lot of people who just don't want to work. We were warned this might happen after COVID. Now, okay, that's just a selection of some of the moves that have been moving the market recently. I don't own Cisco. I don't believe I own Cisco. I don't own Cisco. I did it 25 years ago because if you remember the dot-com boom, that was the baby to have. And then it spectacularly collapsed. Our job back then was, and I kept saying it, if you watch my old Bloomberg TV shows, and any of you who've seen me will know, I always said exactly what I've just talked about, baby, mummy, and daddy bears, which was you exit, first of all, when that happens, okay? You would use that as a pattern. Well, you can test it yourself. Somebody asked, can you use it on gold? On any exchange-traded fund, it usually works. Not perfectly on the monthly charts, not perfectly, but it gives you a pretty good traffic signal. Now, when doesn't it work? Well, look, there's an example where it busts up 1 in 4 times. It'll just keep going higher and higher. It doesn't stop you not getting in. Look, it's done it here. And what NASDAQ's doing may well mean that it's just going to keep doing this. The UK's doing that as well. It's busting above previous highs. That's unusual. That's unusual. Usually when it's up here, it does this. When I say usually, you can just look at previous results of this, back test it, I guess. And if you look at it, the UK's done that, and that's very unusual. And by that, what I also mean is it's going to revert back to mean. It will obviously pull back, but see that move where it's just gone sort of exponential here. That's not because of our macroeconomy. That's because of sterling US dollar. But what's interesting is this is what may well happen to the S&P and NASDAQ. I don't know if it's going to. If I was trying to sell you an S&P fund, I'd say, yeah, it's what's going to happen. I'm not trying to sell you a fund, okay? I happen to be in 2 times leverage S&P 500, which has been great because you're looking at from around April time, 2,250 to about 3,000. So you're looking at 50% return on that. But I couldn't put every single thing we own into it. In hindsight, I wish I had. It's 50% in half a year is not bad, but I wouldn't. It'd be stupid, wouldn't it? Because I'm answerable to my wife as well. My point being, what you've got to watch out is, first of all, you should never do leverage because leverage is risky. Don't do it. And the reason you shouldn't do it is drawdown depth and duration, you're underwater. So write those terms down. Drawdown depth, underwater period, that's what produces your ulcer index. Ulcer index is drawdown depth and duration of being underwater. And the bigger those triangles, the bigger your ulcer. Think of that as the size of your ulcer now. If you get this, then it's less so. So how do you avoid ulcers? Well, stocks, securities with high sortinos, which is high upside returns, low downside volatility, and also the characteristics we look for. So what we do is we cheat. We don't just look at their accounts or the narrative. We don't look at the accounts like P&L, balance sheet, cash alone. We do look at that on there. But what we also do beyond all of that, whoops, there's a little brain emoji. What we also do in all of that is make sure that the ulcers are small, suited to the individual. I might be able to take bigger ulcers than, say, Paul did. Paul didn't want ulcers. And I said to Paul, look, if you can get below 10%, it'd be a bloody miracle. He did it. It's not guaranteed to happen in future, but that's a lot of leeway. In securities, if you can get below 10% drawdown, you should get the Nobel Prize in economics. He managed it. I didn't, so I just stole his idea. It's like the chef's apprentice made a cake better than the chef can. The chef took it and said, hey guys, I'm sharing this with you. It's so good. The point being, and then we avoided curve fitting because we didn't look at history. What we did is we looked at what now looks good: value, growth, income, cash flow. By the way, out of interest, how's it done historically? Oh, historically, it's done rather well. If it does half as well as what it did in the past, we should do really well in the future. And the data looks good. So that's the way in which we looked at it all. And that's really important you understand that. My Apple's doing rather well since it sort of bottomed around April time. Those of you know I got out of the market on the daddy bear around March, April time, and then got back in May once it was out of the daddy bear. And so that, I can't remember the exact numbers, but even if we say 3,000 to 4,000 for argument's sake, 4,000 where we are now, slightly above it, but just assume 4 and 3 is not the bottom. It was 50% above the bottom. What is that? 333% return on that, and fine. But guess what? Anybody who says you haven't got 33% return on this, what does that mean? Did you put all your money in it? Have you just made $1 billion? No. Did you put all your money? No, of course not. Have you made $1 billion? No, of course not. So the paradox is, whether it's right or wrong, it's actually part of a bigger portfolio, and the bigger portfolio is going to end up looking like this. Just because one stock went up 100% or 50%, guess what? There'll be a whole bunch of others which won't have, and so you might end up with that annualized return. Unless you want to gamble on the one stock, in which case you're an idiot, you're a gambler, go to Ladbrokes. So when newsletters talk about, oh, my stock went up 100% on this, aren't I clever? You know the person is delusional, if not degenerate, because they're not thinking at the portfolio level. Or what they're saying is, I don't have a portfolio, I only bought that one thing. Well, great. They're definitely going to lose all their money next time round, because the rational thing to do is they just put it all on black. What would you do in a casino if you put it all on black and made a load of money? Would you walk away? Probably not. Most people don't. They go back until the pain stops. Okay? So that's how you know somebody's delusional or degenerate. They talk about their individual biggest winners. Now, it's fine as a matter of interest to have that conversation, because I know that's what people want to talk about, But the reality is, if they don't talk about it at the portfolio level, there's little clues that tell you somebody's an idiot. Okay, but it is sexy. I know, oh, my Apple picked it this. Of course, I like saying it. But I also know to tell people, well, actually, overall, the portfolio is up less than the big star players. By definition, mathematics. Your portfolio will always do worse than your best performers, because that's maths called averages. Okay, so where's Apple? There. What does it mean? Nothing. So what? Okay, you just got to buy and wait. Would I buy it today? Well, if I want to buy it today, it would be because I want to hold it for 12 months. Yeah. Would I sell it today? Well, it's not a daddy bear. So there you go. What the problem with most people is this. And by the way, if you want to start a trading strategy, if you want to trade, and I don't recommend it because private investors don't have the ability, skill, mindset, and it takes a lot of energy to trade. But let's say you wanted to trade. What you're looking for is any kind of pattern which correlates with this, okay, where the tops and bottoms are. And that pattern might be, I don't know, cycles of the moon, days when your wife's angry with you, moving average prices, earnings, whatever correlations you can find. Test the thesis and hypothesis and say, 75% of the time, this observation relates to the market bottom or the market top. Therefore, it might not be coincidence, and then statistically measure for significance. But don't trade. One reason not to trade, everything I just explained. Sounds a bit complicated, a lot easier to buy and hold. The reason we like these, this is for Apple. I wish out of 10,000 companies, there were more which had this kind of return histogram, because what this return histogram tells me is it makes sense to buy more Apple when it drops. And that's the statistic and the data behind it. I won't look at a narrative and say, should we buy the dip, as I would, people on Bloomberg would. Or on CNBC, I would explain to them why. Not just, I think you should buy the dip because the earnings are strong and, the new iPhone looks really good. That's what's the narrative. It's bullshit. Where's the data? No, I think you should buy the dip because 95 times out of the last 100, whenever it's dropped 25% in the last 50 days, over 250 days, it subsequently moved up a further 45%. That's data, not guaranteed. And as long as it's over a statistically significant period, that's bloody useful. What do private clients do? What do retail investors do? They don't look at bloody data. They gamble. They gamble their futures, their pensions, everything. It's a number of people who are going to ruin their lives. I'll tell you, this is a typical example of what's going on with the markets at the moment. You can have great companies, but they're overbought. What does overbought mean? Look at this. That's the overbought bit, the top part. And does it mean it's going to fall? Right. Does it mean it's going to have it might do. I do not know. I don't know. If you came to this webinar thinking I'm going to tell you, I definitely know buy this, but no, I'm not selling you a bloody newsletter with breathless headlines. Great company, because all you have to do that is give you 20 picks and just market the 10 that went up. Okay. I don't know. But what I do know is I don't mind holding it for longer because value, growth, income, cash flow, Sortino, it's fine. And that's it. People have a habit of over-complicating, over-predicting, private investors especially, and obviously because they see people on TV and they make massive, deep assumptions. Okay? Well, here's another clue why I think it's worth holding for me. In fact, the kind of company I might buy more of. But that doesn't make you a portfolio. To make a portfolio, as we do for clients, Andrew, you for instance, it takes a lot more. And it's a lot more important when you're making a portfolio. Okay, one of the things you want to know when you're making a portfolio is that kind of stuff. What's the rates of return likely to be? What's the probabilities of drawdowns and underwater periods? That's important to know that. How long might something be underwater? Because it stops panic and boredom. It makes sure people know there'll be 7 months you get bored, you get nothing. There'll be panic in those periods where your portfolio drops 10%, but some of the stocks will have gone up, some will have gone down. Also sometimes miscalled diversification. It's not what it is. But anyway, the other stuff we want to know, I can't remember, Andrew, if we've done yours yet, but we want to know are loss probabilities within the time frame that you're looking, and what about at the end? See, it's like owning your house. What's the probability, sweetheart, when we buy that house in St. John's Wood in the next 5 years that we're going to have a loss of more than, say, 10% or 7.5% or 5%? And sweetheart says, well, I couldn't care less because we're going to live in it for 20 years. Oh, what's the probability of going to have a loss at the end of 20 years? 0. That's what matters. But you have to explain that to people so that they don't panic and get bored. Okay. Trading. We're going to go into more stocks. Trading. I've said trading. All neural networks, AI, algorithms, they're working on this basis. What's important, then you weight how important it is, you input it, and you come to a decision, whether it's who to marry, where to go for dinner, or what stock to buy. That's all we've done. Okay. That's all we've done. All we've done here is take in the relevant information and then weigh it. Value, growth, income of those valuation tends to be more important than growth. The growth is increasingly important. Momentum tends to be very important. That's that one. Cash return on capital invested is nice to have, not essential, but pretty nice to have. And to be honest, if you've got the other two, you're going to get croaky anyway. Sortino, very important as well. And return alpha is very nice to have. You can throw in PEG. You really want volatility below 20%. What I've discovered through experimentation is most retail clients can't stomach volatility over 20%. Even if they've only bought £100 of the stock and they're down £10.50, they'll just throw up and throw themselves off a balcony. In most cases. And they claim they won't. They're all armchair generals. When the real bullets start flying down £10, they'll be behind the sofa like a little pussycat. All right. So, that's where we are. The way we weigh things is incredibly, incredibly important. And here's another thing. This is a hedge fund in Hammersmith, Winton Capital, run by Sir David Harding, who, if you know AHL and Man Group, he's the H in AHL. So genius, got a knighthood for services to philanthropy, Cambridge University, PhD in mathematics, I think. This is their chart, not mine. This is theirs, not mine. Okay. And what he said was, I'm going to put some more files up here as well. So, yeah, just in case. There's some more files I'm going to put up and share, which might be helpful to people. Okay. And that's all we're trying to do. We'll get in after when private investors try and predict get in there, and they often get in here. Those are the two worst places. The multi-billion-dollar hedge fund says, look, this is where we're getting. This is a slide they produce for their investors, and their investors are some very rich institutions. And again, private investors, for some weird reason, like to think they've got to get in there, or they've got to act prematurely. So what they'll do is they'll say, "Oh, but you think the market's slowing down? I think I'll get out right now." Everything, as opposed to, well, maybe I'll just slide off a little bit. And they'll say, "Do you think it's the peak today? I better get out." Well, I have no problems getting here. They don't want to do that. Maybe they're greedy. I don't know what it is. We're just trying to work out, is there any pattern recognition which might lead to a fall, then we'll get out, which is based on those movements. Or simultaneously, are there any patterns with those moving average conversion up which might lead to a rise? That's all we're trying to do. It's all we're trying to do. And this is what typically, if you were to, this is not mine either. This is from Hathersage, which is Bill Lipshaw, as I told you earlier, his hedge fund. And this is typically what would happen with investments as well as trading. This is what a distribution of returns would look like on a monthly basis, typically. Now, notice how there are losing months. Okay, that's going to happen. And people find that, no, surely your job is to be right every single month and only have winning months. No, the job is overall to make money. And I'll show you why. I showed you a portfolio, and this will come as a surprise to some of you. I showed you Paul's portfolio here. Okay. The 32 point, that's at the time, it was 52 out of 70, 70% of the time it was positive. 70% of the time it was positive months. Only 70%, 30% of the time, 3 out of 10 months was negative. And this is from a multi-billion-dollar hedge fund, so you don't have to take my word for it. Gurdon, you can find the return histograms on Wolfram Alpha. Wolfram Alpha. Okay. Assets and transfer. Oh, don't worry about that. That's me winning a competition in the Financial Times. So it's not all mouse. Blah, blah. Alpesh talks a lot. No, I publicly have time and again done this. Bloomberg won competition on that. Channel 4, Show Me the Money, if you remember that. Top forecaster. That was me as well. Now, There's a whole bunch of videos I've done on YouTube. You can see them. That's from my younger days. And my God, I've been doing it for long enough that I've got old on TV. And I certainly believe this, that anybody can learn to drive. Anybody can learn to invest. All the books have been about it. Anybody can learn to invest. Anybody can learn to drive. It's the same thing. But instead, you'll give it to idiots like this. When Neil Woodford entered the same competition as me, he narrowly beat the bloody cat. But newspapers love narratives. You know, he had a squarer jaw than I had and a nicer haircut. So they said, you know what? Between Alpesh and Neil, let's give $9 billion to Neil, who narrowly beat the cat. Alpesh just looks a bit too podgy to give $9 billion to. I don't know. It's just the way of the world. It's who you know, not what you know. And he proved it. Because if it was about what you know, we had the answer. If it's about who you know, Mr. Podgkins here knew Hargreaves Lansdown. Hargreaves Lansdown distributed his fund, created a story and distributed it. If you think my industry of finance is honest, you're wrong. If you think it's not corrupt, you're wrong. If you think it's not fully dishonest in trying to take money out of unsuspecting retail clients, you're wrong. And he's one of the many people who are proof of it. Bill Lipschutz, again, remember the first one I interviewed for my first book. If you're waiting to be right 80% of the time, you'll never make it. And that's the problem. Private investors think they've got to be right in everything every month. This is the Dow going back a while ago. Actually, this data would still hold. During the last crash, 2008, so really bad crash, these were the Dow companies how they performed. Okay, that's how they performed during the last really big, bad crash. Look at those numbers. Where's your diversification? Do you see why we have to hold cash, but fund managers can't? Fund managers have to take you down that road. And these are big companies. Coca-Cola was down 26%. Amgen went up. Does that mean you're going to buy it this time? Or Walmart? Or McDonald's? I mean, McDonald's sort of makes sense. Nobody had any money. At least they're still going to eat cheap takeaways. Everything went down. Wait a minute. How come Verizon, the telecoms company, went down and so did Salesforce, the .com company? How come an oil company, Chevron, went down and so did United Healthcare? Where's your diversification? Oh, because they're American. No, that was a global crash. So this whole bullshit that IFAs talk about, and IFAs are the stupidest people on the planet. Honestly, they really are. Because they've been reading from books which are 50 years old. They'll talk to you about words like diversification, spread your risk, and then journalists will repeat that. Some house husband or housewife on the internet will repeat it because they've heard it before. Well, where is it? Where's the data? Show me the data. And I hate embarrassing them with data, but it's the easiest way to embarrass them. Okay, so that's why we had to hold cash, and we held it because there was a daddy bear. I didn't know the whole year was going to be down in 2022. Am I saying there's going to be down again now? No, I'm not saying that. All I'm saying is that's how we do it, and we've always done it. And I've mentioned it you can get my book from 1997, and you'll see, oh shit, I keep saying the same thing. Whoops. We want to tick that box, that one, that. If you don't tick all of those boxes, then it's like crossing the road with your eyes closed. You're taking a risk. You might make it across. You're taking a risk, and you'll make it across, and you'll think, oh shit, I'm really good at crossing roads. So you'll do it again until you get run over. This helps us keep our eyes open. Do you know what fund managers do? Institutionally, they're incompetent, is because they'll sell you a value fund, a growth fund, and an income fund. So they sell you 3 lots of funds, and your IFA keeps busy. Why don't you have value, growth, income in one thing? Why is it not the 3-in-1 printer? Why are you buying a printer of fax? God, they'll still sell you a fax. That's the problem. It's very simple when you do it. And the easiest way to do it, well, for us is this. Okay. Oh, and there you go. Researchers in behavioral finance found that 39% of all new money committed to funds went into the 10% of funds with the best performance the prior year. Despite evidence, this is a sure way to poor performance. I first wrote that in the Financial Times, my column, Diary of an Internet Trader, I think it was about 24 years ago. There's ample research. I then started lecturing this stuff in 2001, 2002, as a fellow at Corpus Christi at Oxford. So, I don't know. Then again, you might say, well, yeah, but to be fair, Alpesh, nobody knows who the hell these 3 Nobel Prize winners are. So how the hell should we know what you've been talking about? Who cares? Thanks, mate. Now, this is what making money is all about. Does the risk double with 2 investments? You got investment A, you got investment B. You got 2 risky investments. I'll talk more stocks in a second and answer your questions. But look at that. You can mix 2 risky investments. You get less risk and the same return. Harry Markowitz got the Nobel Prize in Economics for that. That's what we're doing when we're looking for putting portfolios together. I'm going to see if I can show you something else on that front. Can't share anything proprietary. No. Well, essentially this. I'm going to show you this. In that portfolio of, 20, 30 stocks, not one stock fell less than 9.3%. All of them had bigger drawdowns, but collectively, the portfolio's drawdown was only 9.3. What? The components were riskier than the outcome? Yeah, there's the image. Look at it. Stare at it. Okay, look at it. Stare at it. It's really, really important. Okay, as well. Ooh, Curden, North Yorkshire. I'm a Yorkshireman myself. That's common. You've seen this. Please be aware of that. Processes, procedures are the best way to avoid that. This is probably one of my most important slides. It's too boring for all of you. 30% per annum, Goldman Sachs. This is what they give their rich guys. You got 50 million, they'll do this for you at the private bank. It was recently an event where the CEO of Goldman Sachs International came up to me, put his arm around me, pulled out his phone, started showing people. I'd written about him, and he said, Alpesh has made me famous, my marketing guy. I thought, flipping heck. What I would have given when we launched the hedge fund 20 odd years ago to have the CEO of Goldman Sachs International walk up to me and give me, and show me and introduce me to all his team on the basis of, I'd written an article about some of this stuff anyway, and it went viral. So that's that. Anyway, that's why we look at CROCI, cash return on capital invested. Now, if this is all too boring and you need a dopamine hit, please, by all means, go get a dodgy newsletter which markets their latest success in an up market which has got a very high volatility, because guess what? Pick enough stuff with volatility. Yeah, I can get you 100%. It's not a problem. We'll just do that. Normally 20 to 40 securities is what we're looking at, and the rest in cash is a simple way of doing it. I'm going to show you what you should do in terms of capital. Okay. And we're going to talk more stocks in just a second. Right. This, again, it's from Goldman Sachs Wealth Management. Based on your age or years to retirement, equity allocation, fixed income, read cash. Okay. That's it. You're not going to be able to find CROCI anywhere. What you'd have to do is just look for some kind of measure of cash flow anywhere. I think there are some free websites which allow you to filter, like Yahoo Finance. So you'd have to do that. If you're not a client of ours, where we do all the donkey work for you, and I appreciate 99.9% won't be clients of ours, just as there won't be of Goldman Sachs. But then I think there are some free websites. But what I'm saying is, please have a cash flow measure, a value measure, a growth measure. Don't just have the narrative and some idiot on TikTok said, yeah, this stock went up 100% for me. Aren't I great? They're going to ruin you when the markets are falling, because you're going to get addicted to the dopamine hit. All red flag signs as well. Okay. And this is the poverty gap between British and American. We've got somebody from Washington. This is the gap. That's normally what Britain does. And that's going up the 5 years to 2020. That's when I first showed this to people. It's been 5 years to show this. That's 5 years. That's what happened. And that hasn't changed much despite this past year being good. Minus 12%. Most British people's pension funds mimic that. Very few mimic this. Americans mimic somewhere between these two. So our American cousins get 5 times wealthier than we do over the same period of time, just by being more exposed to their domestic stock market. My SIPs and ISAs are largely US invested, as I said in my first column in the Financial Times in 1999. It's on the record. These are the fees. These are the fees that a general fund will, these are the returns they'll charge you, and the fees will end up being 10% over 5 years. Okay, this is from, that's what they'll promise you. Go look it up. Go look it up. That's weird. Why is that ended there? I'm just going to check. I'm going to pull up the other presentation, but I want to answer questions while we're at it as well. Let me do that because I've got more to cover actually. So let me answer other questions whilst we're at it as well that you've got on there. Anything that I've not answered, just feel free to just post it again. Okay, just post it again. And I'm going to have a look at that. Here we go. Let's see if we've got this one. It's not over there. What other question we got? Sadly, I meant data, damn phone. Do you know over what period, Sortino? 12 months. 12 months is fine. Formula and the data, but I'm unsure if it should be 12 months, 5 years. No, do lifetime. For obvious reasons. The world changes too quickly. Okay, for obvious reasons. There are some more slides I wanted to show you. So what I'm going to do is I'm going to put it up here. And I'm going to do it. Whoops. Okay. Give me 1 second. And I'm going to do it up here. Now, I'm going to answer some more other questions as well while we're at it. Is there any public? Oh, I've done that one. Excellent. 12 months it is. Yeah. Look, in hindsight, we could curve fit, but that would be no use to anybody. Let me just share the screen with you again on this as well. And there's a few other things I wanted to cover. So look, brokers, any of these I'm fine with. I tend to open accounts with all of them. Ever since I have been writing my various books, I've always opened accounts with multiple brokers for that reason. There's a bit more I want to discuss with you on the individual stocks as well. Give me a second to do that. When it comes to portfolios, Sharpe ratio, if you can measure it on your portfolio, please try and get it. Ideally, a Sortino above 3 and a Sharpe well above 1. Okay. Drawdowns are the critical factor. That's the bit. These are various client portfolios. We name them after clients who created them. And you really want to make sure that drawdown is suited to you. Returns everybody loves, but it's the drawdown that people mess up. I'm going to show you something else as well. Each of these various client model portfolios that we have, and we've got more than these, obviously, it's really the drawdown. Okay, that matters. What people look at is they look at returns. And what they forget is not just the drawdown, which you can't see in here, by the way, but the drawdowns are usually, they're not usually under 10%. They're 15, 20%. It would be typical. But also the variance. Look at that, 1.24%. Look at the variance, the negatives. Everyone always ignores that. Imagine you start, and this is the year, and you get 1% there, quality 5 plus. That's about 40 odd stocks. You get 1%. You're going, this thing's broken, mate. It don't work. The parrot's dead. It's what you're going to think. You can take a picture of the 10 commandments. The drive to have a narrative-based stock tip is stupidity at best and gambling at worst. There's number 10, one of my favorites. Okay, please take a picture of this. What should I do? 1, 2, 3, 4, 5. I had to show a client this earlier today. It's stuff I've taught in my books. Okay, those who are on my program get made the model portfolios and they get all the data and the work done for them. Okay, so they don't mess it up. Where are we on this? We're still at 1. Rising but overbought MACD. Risk averse, be cautious or stay out. Risk neutral, add to winners cautiously. Risk loving will buy. 70% chance of a 10% drop in 6 months. When we get a 10% drop within the next 6 months, you'll say, Alpesh, how did you know? You're so clever. No, I didn't. It's just statistics and probability. It's all it's ever been, has been statistics and probability. Okay. I account with a monthly charge and one free trade. This definitely hits the portfolio. With a monthly charge. How big's your monthly charge at Interactive Investor? Have a look at Interactive Brokers. They might be cheaper. Have a look at Free Trade. They might be cheaper as well. Sorry, that's from before. You can ignore those. What do I want? Oh, I wanted to show you this as well. Look, that's the 0%. Look at how many companies are below zero. Look at how many are above the Standard & Poor's. Very few companies are above. Is that good? Is it bad? We don't know. What we do know is I do own all of those biggest bubbles. But we're not trying to gamble on trying to find which is this top one. That's for the newsletters to do, okay, to try and convince you they've got a crystal ball. They haven't. Don't take my word for it. Jim Simons will tell you that. Now, this I've covered. There's other stuff I wanted to cover as well. That over a 15-year period, 93% of fund managers underperformed their benchmark. You could just copy the benchmark because the benchmark is usually an exchange-traded fund you could just buy into, but they regularly miss it. The US market has consistently outperformed the rest of the world over the last decade. You might say, well, it's going to end today. Yeah, it might end on your watch. There might be a convergence between Asia, Europe, and US. Who knows? I'm not picking them because they're American companies. I'm selecting them because when we go through our database, they appear in the top. And I've gone through enough bear markets, and I've given my speeches, Alpesh Patel, who will lead a discussion of my own bear market, or for Barclays. I've got enough experience over the last 25 odd years, let alone longer, to know that it's not about the bull market. Everyone looks clever. I even got into GQ. Whatever happened to that lady? Okay. What else do I want to show you? Not that. I want to draw to your attention something else. Not these. I've covered these in previous. I'll do some of these in future ones as well. So I'll go. I sometimes go over the various stuff. I do that with my mum as well. You don't need all of this. Oh, by the way, one of the reasons why, look, the European bank ETF I've got, but on the whole, why Europe doesn't sort of float my boat. Where's it gone? There was a map of there it is, map of the United States. I mean, come on. That's how big that economy is. Now, I'm not picking stocks from America because they're American. I'm not racist or biased or whatever. It's just that those companies listed there happen to percolate to the top. And when they fall, everything falls anyway. That other one didn't matter. Let me show you something else. Don't worry about these. There was a reason for ABBA being on there, by the way. So I recommend, feel free to take a picture, get your phone out. Okay. There's other stuff. For those interested in the program, more than happy to take more people on. Not a problem. We have now got a team of 14 at headquarters. I say headquarters around the world. Okay, that's another model. That's from 2017, which the idea is if it does half as well as this and double the drawdown, am I still comfortable? Yes, because I know I've planned for double the drawdown and I've planned for half as well as this, and that still doubles the money in 5 years. Why am I confident about that? Because that just averages the S&P. How much do you need? Annual spend times 25 is what they say you need in retirement. There's the numbers. 40,000 a year requires $1 million, roughly. Actually, we've done better than that. We've created a whole bunch of free tools for you at campaignfor1million.com/tools. Have a look at this. Okay. Campaign for $1 million. These are all free. And they'll even tell you your safe withdrawal rate. And this is something which people really should be aware of. What's your safe withdrawal rate? depending on starting. And you can put all the numbers in, and it's free, and it'll calculate. It'll even explain things to you, and how much you might need, how much you might want, how much you can safely withdraw given the growth that you've got. And we've also got a portfolio stress test and sequence of return. Again, sort of works the stress test out on your portfolio, depending on how much you've got and how much growth and how you move things around. What's the probability you'll have enough for your lifetime? Okay. And what's the, 30 years in retirement? There is a probability, and there's 10% of the time you'll run out of money. So it gives you an idea of what might happen depending on your withdrawal rates and so on. All of that completely free. campaignfor1million.com/tools. Somebody's written $11.99 for some reason. Not sure why. Okay, there's other stuff I want to show you still for those on. That's the website where you'll find all the tools and the freebies. Growth rate is the most important thing you can do. That's where I come in. My job, very simple for my clients. Give them the data and the transparency so they can make a model portfolio which we can analyze and get them the highest possible growth for their drawdown. It's simple. Why? Because 100,000 over 15 years, if it's 5% per annum, only becomes 207,000. That's St. James's Place. That's Fundsmith. 15% per annum, that's the S&P 500. So worst case, if we even did that, that gets you to 813. 30, if Donald Trump stays president forever, probably 30% per annum. It's an expensive price to pay, but I reckon if you went from 100 to 3 million, you'd say, fuck it, let him be president for the next 15 years if he keeps generating 2023 and 2024 stock market returns. Hey, everybody's got a price. Yours is 3 million in your pocket. Now we know your price. Okay. Growth is the bottom line. Growth is what matters the most, because you can't make your life longer. You don't want to be saving more. So growth is the easiest way. And those are just some of the numbers. We actually work it out for you. We've got another tool where we show how big a difference growth makes. Okay. And this is one of the reasons why I'm so confident. Positive returns, 88.5%, to average return, 32%. That's just the S&P. That's just the tailwind I get on my back. Okay. And that's the S&P. We look beyond the S&P, obviously. Okay. This is another little growth calculator we've got. Current portfolio value, say £200,000. If you get a 10% improvement, your return on investment is 2,272. That's with the program. It shows how powerful growth is. A small movement in growth and what a big difference it can make in terms of returns. It's growth because of the compounding impact of growth. Okay. If you don't know how to get rid of your IFA, that's what you need. That's the letter. Take a picture, pause it, get your camera out, take a picture. And if you were St. James's Place, that's how you get rid of those. They've got about 1 million clients. I want all of them to be part of my Great Investments program, because I think all of them have the capability to invest and learn to invest themselves. It's that simple. And so why aren't they? I could teach every single one of their clients how to invest for themselves, give them the data and let them do it themselves. But people go, no, surely they can't. Well, why do you think SIPs and ISAs were invented? So they could. And that firm shouldn't exist. Just shouldn't exist because it doesn't make sense. It does not make sense. That's how we do it. We do all the donkey work. From the donkey work, we create those and give people all this education. And we've had a great market in 2024. I can't take credit for that, but notice how we weren't up 150%. NVIDIA was for us, but we weren't. We're only up that because there are ones which didn't do as well. Because if we were that good, we'd be up 150% or 515. I didn't know it was going to go up that much. We've got an idea what probably might go up, and sometimes it doesn't. Sometimes it doesn't go as much as we thought. This was 2023, but the market was great. 2022, 0% return. If you want to see the returns and everything else, alpeshpatel.com/shares, and you can have a look. And you can see 0 in 2022 when the market fell 25%. You'll see it here, alpeshpatel.com/shares. We've also got some free resources there as well. alpeshpatel.com/shares. We compare it to all the others. If you go down here, you'll see there, you'll see a 2025 returns report and all of this, and also some tools, why your pension's losing money with fund managers, all of that you can watch, what returns you should be aiming for, and so on. View more. Okay. So there's a whole ton of stuff there. That's an advert that we're going to put up for. We're finalizing that. It's not finalized yet. I've really got to pull my finger out about that one and get it ready. But that was the first draft. I've kept it on here. But that's what we're going to do. And put up there. Right. I want to show you one last thing. If you want to be part of, the program, always on my webinars, I give a discount for people who are on the webinars. My goal is, I don't know, maybe get 500 people on it. I wish it was 350, but get 500 people on it globally from around the world, prove to venture capitalists it works, and then take on venture capital investment and make a different kind of asset management company where you get the data from us, you get the knowledge, you don't pay a subscription, you don't pay fees, you manage it with whichever broker you've got. With our education, we're education. We're not managing your money, you're managing it, we just give it to you. The education and the data for life and access to me and my team. And I'll always be the one mentoring you for the first 500-ish people anyway. I say ish, 500, full stop. And you're the proof. The reason for the first 500 they won't pay any extra fees beyond the one-off is because I want to prove the concept to VCs. And I think we can replace St. James's Place. That's the goal. Replace them, remove them, eradicate them. We've got a lot of their former clients so that people have the transparency and the data and the knowledge to do it themselves. Handheld, educated handheld. I'm your driving instructor. Give you the data, give you the knowledge, one-to-one tutorials. So you're in charge. And you might use Interactive Brokers, Barclays Brokers, Free Trade, Hargreaves Lansdown, doesn't matter which ones. That's our goal. That's what we do. And that's what I want to keep doing. And I think we've got something which is pretty amazing. Left at James and now have 5 years return 11% with them, 3 years I doubled it. Well, there you go, Marcus. There you go. 5 years with St. James hit 11% and in 3 years you doubled it. The number of people I know who are just so angry with them, with St. James's Place. The funny thing is their head of economics is a friend of mine, but she's only head of economics. She's not a fund manager. It's their fund managers and their institutional structure. And her husband's a really good friend of mine. But she's great as an economist. I love her. She's brilliant. As an economist, she's an economist. Doesn't pretend to be a fund manager. She's not a fund manager. She doesn't pretend to be it. But their whole structure is wrong. It's not just them. Eugene Fama got the Nobel Prize in economics for proving it. It's all of them. Any other questions? If not, I'm going to go. Listen, 1 hour, 36 minutes. Really sorry it's gone on so long. I don't normally make it so long. I'm going to share some more information with you on here. Okay. So do have a look at that. You can still email me any questions you might have. Feel free to do that as well. And we'll take it from there. Okay, for everybody who's signed up, thank you very much. I will email you shortly with the login details and everything else. So you've got access to everything. And if you want to know what everything is and why I think it's so bloody good, in fact, I'm guaranteed it's so good. I certainly enjoy it more than the hedge fund business. I have to tell you that. The hedge fund business, you're just making rich people richer. With this, you're dealing with regular people and educating them and empowering them to be better themselves. That's certainly more fulfilling. Okay. That's what we do. That's the essence of the program. 3 simple steps. Any questions, let me know. I hope you enjoyed the webinar. I mix up the slides. I want to get for every well, thank you, Paul. Really appreciate that. Thank you very much. It's very kind of you to say. Paul, are you coming? I don't know. You might be a bit far away. Are you coming on Monday to the office at Gresham Street? I'm doing Just for Great Investments program. I don't know if you saw it on Telegram. Just for Great Investments program people. We're going to have about 20 of us get together and I'm going to do a stock market update to everybody there. But if you are, then do ping me. I'm not sure if you did already say you are, but we can. On there. I just want to see if there's anything else that I want to show people on here. No, that's it, I think, for now. Oh, maybe this is interesting to people. Oh yeah, there it is. It's on the screen. Net income, free cash flow. The free cash flow seems to be decreasing for some of these companies. The net income still keeps going up. For net income, you can read profits. They're getting more and more efficient. Put another way, let's see if I can pull that up. Capital expenditures quarterly. Look at that. Capital expenditure is going through the roof, but they're cash flow positive and they're profitable. So we don't need to worry at the moment unless somebody makes it. Oh, Paul, no worries. Well, I'm going to record it anyway, so you'll be able to see everything. So it's not a problem. Other than that, thank you all very much. I'm going to call it a session right there. I have got to, where have we gone? I'm on this slide. So thank you all very much. And I will, that's what I was looking for. And I will speak to you soon.